Hey folks, it's Simon here. Welcome to your Tao Daily for Thursday the 20th of March 2025. The S&Ps didn't manage to follow up on Fed Day's rally today. We had a positive reaction to the Fed yesterday. Today, an attempt at a rally, couldn't stick the highs. In fact, ended up closing down 0.3%. Where this leaves us is technically not a great spot, okay, because we're below the 200-day moving average and we failed to close above this blue rectangle, which I've had on my charts for a couple of weeks now. This is a support resistance level that we failed to close above. All right, so a lot of people now are saying, well, that's it. That's the end of the bounce. This was just a pause before the next leg down. Now, assessing the technicals is important, but you also want to be laser focused on a handful of critical market signals to decipher whether this consolidation near the lows is in fact a bottom forming or whether it's just a breather before a further sell-off. So some of those critical signals include things like volume and breadth. Now, we had a big spike in volume back here, and then as this sell-off progressed, it did so on declining volume, which can be a sign that sellers have run out of ammo. All right, we're kind of just running out of sellers down here. If we have a look at breadth, there's a couple of ways we can view that. One is the advanced decline line, which is hovering near all-time highs. All right, so market breadth is not looking bad. The advanced decline line is outperforming the S&P. Also look at the number of stocks trading above their 50-day moving average. Now, that's pretty pathetic at the moment at 31%, but what's more interesting is what often happens when this figure has a V-shaped recovery. As it did there, the S&P bounced hard. As it did there, we had a small bounce. There, we had a massive bounce. Here, we had a massive bounce. Here, we didn't even really have a pullback. Here, significant bounce. Here, significant bounce. Here, big bounce. Here, decent rally. Here, we had a decent rally as well. All right, so often when this thing does that, the S&P is also kind of doing that. So breadth, reasons to be positive there still, I believe. Let's take a look at the VIX. So the volatility index is my pulse on fear, and a spike in the VIX that we saw back here near those lows, followed by a quick drop-off, often signals that the panic has peaked, and this is often a classic bottoming signal. Now, if the VIX had been creeping higher during this consolidation, I've been more concerned, but it's actually leaking lower. It's also worth dissecting sector rotation to see what's moving under the hood. You can see here over the last 5 days, the strongly performing sectors have been cyclical, all right? Energy, financials, industrials, tech is growth. Here's the S&P 500. So the more defensive sectors like utilities and consumer staples, not only have they underperformed the more cyclical or more growthy sectors, they've also underperformed the S&P over the last 5 days. So that's an indication that we've got some risk-on positioning happening there under the hood. So, yeah, technical picture on the S&P, it doesn't look amazing, but there are some good reasons, I think, that this bounce may not be done yet. That's what I got for you. I hope it helps, and I'll catch you next time.